Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. This is Craig Jeffrey. I'm your host for today's episode. The session is entitled Surety for Treasurers. I'm joined with Jack Rosenberg from Rosenberg and Parker. Jack, welcome to the Treasury Update podcast.
Craig, it is fantastic to be here. So honored that you guys are having us.
Glad to have you on as well. You know, surety is not something that the majority of Treasury people know really well, and there's new and good opportunities. So this will be of great interest to the audience. And for those who are listening to this one directly, there's a coffee break session in the show notes on Surety 101. And that John is interviewing Jack on that one with a really good background for the foundational aspects of surety. We're going to cover some of that ground again, but we're going to go a little deeper. So Jack, maybe we could start off with what is surety and how can we understand surety compared to insurance? Like how does it, we think about it, it helps manage risk. So how do you compare and contrast that?
It's the right place to start. And if people listen to the coffee breaks, they'll see this. But I struggle to explain surety without talking about insurance. Like it's hard. And part of that is because they're similar parties. Sureties are just divisions for the most part. There's a small amount of pure play surety companies. But for the most part, 95% of the time, sureties are part of larger insurance companies. Nationwide has a surety division. Chubb has a surety division. Travelers, Liberty, all have surety divisions. There's also big insurance companies that don't have surety divisions. AIG got out of the surety business. Like there's Progressive is more Allstate. Those are more consumer facing. They don't have surety divisions, but almost every single surety is part of a larger carrier. Where it differs. And this is, again, I don't know how to explain surety without explaining that it's not insurance. But where it differs is fundamentally, you have three parties instead of two parties. So, Craig, when we were preparing for this, I'll give the exact same example, which is comparing surety to health insurance. So in America, health insurance comes through your employer, and it's a two-party transaction. They know people are going to get sick. You get sick. Or let's say you have surgery. Once you've paid your deductible, you file a claim. You're the insured. The insurance company, God willing, pays your claim. It's as simple as that. There's an insured. There's an insurer. The insurer expects there to be claims. Let's all hope they pay out the claims when we need the insurance. Surety, three parties. And the example we always give is the paving of a road. So Rosenberg and Parker is headquartered just outside of Philadelphia, Pennsylvania, in Wayne, PA. Right outside of our doors is Swedesford Road. And I can't remember if Swedesford Road is a county road or a state road or something in between, but let's pretend it's a state road for today. That way I can just use the Pennsylvania Department of Transportation. So let's say the Pennsylvania Department of Transportation, they're putting out the paving of the stretch of Swedesford Road that is right outside our office. Let's say it's the 2-mile stretch outside of our office, Craig. And let's say Craig's construction company and Jack's construction company are both bidding on that road. Craig, you bid $2 million. Jack bids $2.5 million. Craig, your lowest bid, you win. So because it's put out by the state. Pennsylvania bonds all of its road projects for the most part. Pennsylvania Department of Transportation is going to require a performance bond. And Craig, let's say your surety is Nationwide. Nationwide is going to make a guarantee on behalf of Craig's construction company that Craig, you will pave the road in accordance with the contract for the $2 million that you bid and for not a cent more. The claims process is where it really differs from insurance. Let's say, Craig, you go out of business, you go bankrupt in the middle of this job. Well, Nationwide steps in and they have two choices. They can either pay the Pennsylvania Department of Transportation $2 million. Hey, here's your $2 million back. We're good. Go find somebody else to pave your road. Or they can go hire somebody else. Let's say they hire my contracting business to come in and finish the job because they view that as they can do that for less than $2 million. That's the economic calculation that they're going to make there. Like we talked about in the coffee break, it's like, well, hold on a second. You just had a claim and the insurance company paid directly to the Pennsylvania Department of Transportation. Nationwide paid them. How's that any different than the health insurance model? And the difference is more easily explained where Craig's construction company is not going bankrupt. Like the difference is fundamentally there was still a third party. There was still Craig's construction company, but it's easier to see that when Craig's construction company walks off the job, doesn't go bankrupt, and just says the Pennsylvania Department of Transportation is being a bad actor, and we're not dealing with this. We're walking off the job. Craig's business is still intact, and here's where it gets different. What governs the surety is writing a bond to the Pennsylvania Department of Transportation on behalf of Craig's company. But what governs the relationship between Craig's construction company and the surety is what's called an indemnity agreement. And the indemnity agreement holds the surety harmless for any losses. It's more akin to, I think this would be more familiar for your audience, Craig, it's more akin to a credit agreement in the sense that, like, hey, we have to pay you back if there's a loss and we're still in business. So, Craig, you guys walk off that job and it turns out, you've been running this business for a long time. You have, let's say, $10 million in net worth and $5 million in the bank. Nationwide is going to come after you and they're going to hold up their indemnity agreement and say, Craig, you signed this. You held us harmless against any losses. You just walked off that job. It cost us $1.2 million out of our own pocket to finish that job. You need to give us $1.2 million. And there's a lot of precedent in the courts for sureties being able to turn to their indemnity agreements and enforce them. So that's how it's different. It's not just, oh, there's a loss, insurance company pays out, well, we expected this. It's, oh, there's a loss. First, Nationwide is going to see, do we have any recourse to Craig's construction company? And they're going to turn to their indemnity agreement. Because fundamentally, while insurance companies, when they're writing insurance, they're underwriting for a certain degree of claims. In their perfect world, let's say they write $1 billion worth of premium and they project $900 million worth of claims, and congratulations to that actuary. It came in on the dot at $900 million and they know their overhead's $50 million. Well, great. They made $50 million in underwriting profit. Sureties are never trying to produce $500 million of premium and then say, all right, we're going to have $400 million in claims and losses. They're trying to write $500 million in premium and have zero losses. That's the big difference.
So that makes sense. We talked about different number of parties as well. On the insurance side, we have the insured and the insurance company, and there's obviously an insurance policy. So maybe we could fill in on the surety side. There's a principal, which is equivalent to the insured.
Yep.
There's a surety company. And then the third one, which there's no analog to in the insurance environment, is who's that third party?
That's what we call in the surety world the obligee. Since your audience base, Craig, is a lot of treasurers. I know treasurers a lot of times in their remit is handling letters of credit. You can think of the obligee as another word for the counterparty. It's the entity that's demanding some amount of financial assurance. And that assurance is coming in the form of a surety bond. And I say assurance, not insurance, assurance, right? It's financial assurance that a contract will be performed, not just a construction contract, this can be any contract, but a contract more generally will be performed in accordance with the contract.
So if I'm Craig Construction Company, I'm the principal, and let's say in your case, I can't remember which insurance company you use, they're the surety, and then the obligee or the counterparty would be the state of Pennsylvania or my customer. Yeah.
Your customer, exactly. And it's not always, we use that example because roads are everyone knows what a road is. Everyone's seen roads being paved. That is universal. And I use the Pennsylvania Department of Transportation because government and municipal entities are in general big users of bonds. They definitely make up, there's more public and, municipalities or state governments or federal governments that are the obligees. Again, think of obligee as the counterparty. They're the ones requiring the bond. Then there are private individuals requiring the bond. But Craig, your customer could be the one and that could be a private entity requiring the bond.
Yeah, that's a good example. I really do like counterparty much better than obligee, but I'll try to stick to obligee during our discussion. The next question I wanted to ask you is, what challenge or challenges does Surety help to solve? And some of that becomes obvious. It's a way of providing financial assurance, like insurance, but ways to cover. Maybe you could help address that, because I think that's part of the applicability to the domain of the treasurer.
We just gave the road example. That is, in my opinion, not as much as surety solving a problem, but surety being a requirement. When surety is a requirement, well, the only problem it's solving is you have to do this in order to run your business. It's a need to have, so it allows you to run your business, right? But if you go out of the construction space, and let's say you go into, I'll use an example, the travel space. So we have a client that does very high-end, I don't know what you want to even call them, like trips around the world. To give an idea of just how high-end these are, like your one ticket for a 21-day trip, and they plan everything out for you, right? They have the hotels, they have the travel, they have all that. But one ticket can range anywhere from $185,000 to $250,000. So, just a down payment on $1 million house in the United States, right? That's it, just for one ticket, right? It was set up in a way where they had to, according to the regulations, and I believe this was the Federal Department of Transportation that had this set up this way, they would get deposits. I think they had to have 25% 365 days out, 50% half a year out, and then 90 days prior to, they had to have the full amount paid for. The great thing for the company is they're cash flowing a lot of the deposits they're making on the hotels, on the experiences, on the plane with customer money. But here's the issue. Unless you put a surety bond in place to guarantee a portion of those deposits, you had to safeguard those. They had to sit in basically an account that was just earning that high yield savings rate, and that's it. You couldn't actually cash flow these trips with customer funds. So in that instance, what a surety helped solve for is we posted a surety bond, and now let's say the surety bond was $15 million, freed up $15 million of cash. Surety bond only costs, in general, surety bonds are somewhere between, on the very low end for your massive, publicly rated, very large companies, we've seen as low as 15 basis points. That's really, really low. The majority of companies are paying somewhere between 50 basis points and 300 basis points. And if you think about this company, they were going to have to draw down on their revolver and pay their SOFR plus the spread for that cash in order to fund these trips. Well, now they can fund it with customer cash. So a lot of times it's solving liquidity issues. And another example would be, we have a client who's a developer. They're developing a large transmission line. Along the way, they run into different parties that want some sort of financial assurance that they're going to do something. In this case, it was the New York Department of Transportation wanted the guarantee that basically the road that they were going by that they needed to dig up next to was going to be restored back to spec. And they could post a letter of credit, or they could post a surety bond. Well, nice thing about surety bonds, it's off balance sheet. It's a contingent liability. If they had needed to post a letter of credit, they would have had to post it off their revolving line of credit. It would have counted against their leverage covenants. Sureties frequently, the most common example is, well, you need it to run your business. And in that sense, it's similar to insurance, even though it's different. You have to have it, turn the lights on. But in many cases, usually where we're adding value, where we really, someone's interest really ticks up and they start listening, is when they realize that surety can replace letters of credit or can be used as some sort of financial assurance to free up cash that's otherwise trapped, that's not being used properly.
From the ways to cover standpoint, I think you gave an example of cash with that first example, and then this last one, having a surety bond, letter of credit. And one example you gave me earlier when we talked was surety-backed letters of credit.
Yes. I think that's probably the tool that's going to be most interesting to your audience, because those who are familiar with surety bond, your audience, like I would imagine many of them would say, yeah, Jack, of course. We post a surety bond whenever we can because of everything you just laid out. It's off balance sheet. It's a contingent liability. It doesn't count against our leverage and our covenants. It tends to be cheaper. It's not taking up space on our revolving line of credit and sapping our liquidity. Like there's a lot of reasons to do it. And I gave the example of, I think this was in the coffee talk of posting it for insurance deductibles, right? Insurance companies will take, like if somebody has a $25 million deductible for their insurance policy, that's a lot of counterparty risk that the insurance company is taking. And a lot of times they want financial assurance posted from somebody that's not their insured, guaranteeing that the deductible is going to be paid. And what I left out in the coffee talk is that while this is getting better, a lot of insurance companies, and it's very frustrating for me as an insurance person, but like Chubb and Travelers and Zurich, they'll only take a portion of that in a surety bond. It frustrates me because it's like, guys, you have enormous surety divisions. It's not a ringing endorsement of the product if you're not willing to accept it entirely for this piece of financial assurance, but that's for another conversation. But what your treasurer is probably saying, yeah, I can only post 35% of that financial assurance with a surety bond. The remaining portion, I have to use a letter of credit. So why is this interesting? Like, you know, how do you solve that? And that, Craig, is what surety-backed letters of credit solve for. And so a surety-backed letter of credit is pretty much exactly what it sounds like. You basically take a surety bond and you wrap it in a letter of credit. So let's say Chubb is the counterparty here, and you've already posted, and let's say you have $10 million in financial assurance that you have to post to Chubb, either via cash, letter of credit, or bond. You're obviously not going to post cash because what's the point? So, and let's say 3.5 million are posted with a bond, 6.5 million posted via letter of credit. The surety-backed letter of credit product allows you to post the entire thing with your bonding capacity. 3.5 million still coming from a standard bond, but the 6.5 million is now coming from this surety-backed letter of credit product. And like I said, what that is basically a letter of credit wrapped in a bond. So how's that work? Well, the surety is still taking the underlying risk, but most sureties are really strong credits. We're talking, A- or better, many are AA or better. And so they can get banks to front for them for a medium, trivial amount of money. Let's call it 30 to 40 basis points. And obviously trivial depends who you're talking to. If you're talking about, Google's not our client, I know nothing about their program, but it wouldn't surprise me if Google had, a 15 basis point rate, right? So if you're Google, that's not really that appealing. But if you're in the, let's call it double B minus, double B plus credit rating, well, there's a chance that even if the bank's fronting fee is 35 or 40 basis points, that plus your surety rate is still better than your letter of credit rate. And again, you're freeing up that leverage. You're not posting that off of your revolving line of credit. So Chubb has a relationship, let's say, with SMBC. SMBC is really taking Chubb's counterparty risk. That's why it's so cheap. Chubb is still taking the underlying counterparty risk of the client. What's happening here, though, is because it's a wrap, the counterparty still gets their SMBC letter of credit. They don't care. They don't know, and they also wouldn't care if underlying that is a surety product, because that's not what's facing them. What's facing them is a letter of credit. If the client doesn't pay their deductible, they can draw on the SMBC letter of credit, and it doesn't matter if that was posted off of their revolving line of credit or off of a front for Chubb, because the product still functions the exact same. So that was a very long-winded way of saying what the surety-backed letter of credit product does is it allows you to use your surety facility even in the instance where a counterparty won't accept a surety bond for that given obligation.
I wanted to take a quick break, and maybe you could do an introduction to Rosenberg and Parker and a little bit about your background, so that people know who they're listening to.
Rosenberg and Parker is an 80-year-old surety bond brokerage and advisory firm. What makes us unique is that all we do is surety. We specialize in surety. We don't offer any other lines of insurance. The company was started by my grandfather in the 40s as a general lines insurance company. So we used to do insurance. But I forget if it was the 70s, the early 80s, my father, who at that point was CEO, he just had the realization that his surety relationships were less transactional. They were more about being an advisor. It was a really long-term relationship. Whereas he felt that the insurance was, he was more of a broker. Like the reason we call ourselves a surety bond brokerage and advisory firm is the idea that if you lead with advice, whether it's good for whether that's good for the client, regardless of whether it's good for Rosenberg and Parker, you will have build decade-long relationships. If you're just brokering business, it's transactional. You're not adding value. It's through the advisory piece, and my father felt that surety was far more of an advisory business. And then the other thing that I would want to communicate on this to sort of qualify Rosenberg and Parker to the audience is, we went through some iterations. Like my grandfather Charlie, we sort of were talking about this offline, like why we kept the Parker. Well, it's because being Jewish back in the 40s, like that created some frictions in doing business. And so if you go back to him and you look at it, he was working mostly with like Greek Orthodox, Jewish, and Italian subcontractors in Philadelphia, like small guys who were like paving the sidewalks and winning small contracts. And then, my father was able to add on some of the more blue chip, larger general contractors and subcontractors. But the part that I think is relevant for your audience, Craig, is each sort of generation has put its spin on the business. And my two older half brothers started in the 90s. And by the late 90s, they sort of had the audacity to say, why shouldn't we go after some of the largest companies in the world? And one of the first cold calls they made was Honeywell, which at the time was Allied Signal. Right place, right time. Brought on Honeywell. I think from like cold call to meeting, they had the account in like less than a month. They thought it was going to be really easy. Not easy. But since then, we've asked, we work with our clients are two of the Fortune 10. We have, I think, 30 to 40 Fortune 500 size clients. And that was the addition that my two older half brothers, Chad and Matt, who are CEO and COO, that's what they put on the business. And then Harry and I and our other partner, James DeShulo, have really grown our energy and financial sponsors practice. And this really came out of, COVID happened. And at the beginning of COVID, there was a real liquidity crunch there for a couple months before the Fed sort of turned on the money printer. We had been trying to crack this, Harry worked at Blackstone at the time. We were trying to crack that, can we get in front of anybody? Can we get them to listen? And all of a sudden, there was a real need to replace letters of credit to free up capacity and liquidity. So we were able to bring on a couple of those clients at Blackstone, and now we work with 7 of the 10 largest mega funds. And our firm over the past 3 years has gone from, over the past 5 years, gone from about 23 people to I think we're over 65 now, or about to be 65. So we've grown dramatically in that time, and that's a little background on us.
I know we wanted to talk about how surety has changed over time. That history is actually really quite fantastic, and maybe we can get you on for another podcast on that. But I wanted to have our final section on this to talk about what are the most common use cases of surety. And again, from a treasurer's perspective, where is surety used most frequently today?
Absolutely. So I would think about a couple different buckets. I would think about any financial assurance that needs to be posted to an insurance company to guarantee the payment of a deductible. So that could be a large auto insurance program. That could be a large workers' comp program. Like anything where you're talking big numbers, where the insurance company wants a guarantee you're going to pay their deductible. That's an example where if you're currently posting a letter of credit, a surety bond or a bank-funded surety bond can be used. I would think about the energy space. Pretty much anything in the energy space where you're not purely guaranteeing the payment of principal or interest on debt, a surety bond can be used there, especially the bank-fronted surety bond. And one other example I give is in the private equity space, and I'm more giving examples, Craig, of where it's not you need to have it to run your business. It's where you're optimizing how you're using liquidity, and you're optimizing your capital structure, and using surety to do that as a small part of it, as another tool in your treasury toolkit. And that's literally the words we use when we get on with treasurers, and a lot of our clients. The surety program is run out of treasury in addition to the managing letters of credit. That's how we talk about it. You never want this to replace your letter of credit facility. You want it as an additional tool in your toolbox. And so the last example I'd give and we've been an innovator in this space is guaranteeing equity contribution in the private equity world. So let's say you have a big greenfield project, and private equity funds in general, whether this is a big greenfield project or any investment they're making, they're being judged on their IRR, which is a time-tested rate of return, right? And if they can put their equity in later on in the project as opposed to earlier, obviously you delay the start of that IRR clock. The banks, especially for greenfield projects, have said, okay, that's fine. You want to back end your equity. This is a 4-year build, and you want to back end your equity. Okay, but we want some sort of financial assurance. We want overwhelming. We want a letter of credit guarantee from a financial institution guaranteeing that you're going to do that. Well, most private equity funds have what they call either a fund line or a subline. Basically, it's a revolving credit line for a private equity company. It's based on the capital commitments of their limited partners, which are essentially their investors. But they use that fund line to make acquisitions because calling capital from limited partners is it's a time-intensive process. That's not, when you're asking somebody to send you $20 million, that's not just calling somebody up, hey, yes, send it over, right? There's a lot of compliance and stuff that goes into it. So generally, these big financial sponsors, they only want to call capital from their investors twice a year. So they use their revolving line of credit to fund acquisitions and then call capital twice a year and immediately pay down that line. So having a long-dated letter of credit that's for a large dollar amount sitting on that line for years is really inconvenient. So we've been able to use Surety to solve for that problem. And I would say more generally, like the best way to think about this if you're a treasurer, if you have letters of credit that are supporting a long-term transaction, whether that is putting hydrocarbons on a pipeline, guaranteeing that you're getting a certain amount of power to another entity, whatever that performance is, guaranteeing that you're going to make your lease payment. If you have long-dated LCs and they're not guaranteeing the payment of interest or principal on debt, a surety bond, and especially a bank-fronted surety bond, is a potential tool for getting that long-dated letter of credit off of your revolving line, or just freeing up a bilateral credit facility more generally and maximizing liquidity.
Excellent. Thanks, Jack. I know there's more we could go into on that, but I really appreciate that series of items that can matter to treasurers. Surety is really an interesting topic. Thank you so much for your input.
Thank you very much, Craig. Thank you so much for having us, and I hope to do it again soon.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.